You've built 65 lakhs for your child's college admission, which is in 2 months, and suddenly the markets correct by 30%. 65 lakhs becomes 45 lakhs. What's your exit plan? Most investors don't have one because no one teaches exit strategies. Don't worry, as always, I've got you. It's fixable through STP. Systematic Transfer Plan. This video is for investors who are investing for specific long-term goals and don't know how to exit safely. I'll show you how investors protect this goal corpus without having to predict markets. And we'll discuss how STP works through this simple example. I'm CA Vamika and I share actionable and data backed investing frameworks for long term investors like you and me. So, do subscribe to the channel to not miss upcoming videos in this series. Okay, you climbed the mountain and averaged your entry with systematic investment plans. Systematic transfer plan is descending from that mountain slowly and systematically. STP simply means transferring money from equity to safer, less volatile assets. Ideally, this exercise should be done much before the goal date to ensure your goal amount is safe. This systematic transfer exercise can be automated on a monthly basis. Let's understand with the same example. If 65 lakhs correct by 30%, you are left with 45 lakhs. Shortfall is of 20 lakhs. But you have reached your goal date. It is not a return problem. It is a timing problem. This is called timing risk. And timing is the one thing that investors cannot control. So, what's the smarter way? By reducing equity exposure gradually, we can reduce portfolio volatility significantly as we go closer to the goal date. Let's assume you have been accumulating in SIPs for your 10-year goal. Now, the goal is 3 years away. Instead of exiting in one day, you can spread your exit over 2 to 3 years. You can decide how many years before you want to start exiting. Is it 2 years, 3 years, or 4 years before the goal maturity date? In this example, I'll start exiting 3 years before the goal date. Why 3 years? Because according to me, 3 years is long enough to average out exits and short enough to not miss too much equity growth. Let's understand the math with a real example. Let me show you exactly what happens year by year. Suppose the goal of 65 lakhs is to be achieved by June 2028 and from 2018 to 2025 you have been doing monthly SIPs of 35,000. I have assumed 11.5% returns for equity post-tax and 5% returns for debt funds post-tax. Okay, June 2025. It is T minus 3 years. The monthly SIP of the last 7 years has compounded to almost 45 lakhs in equity. Now you decide to start transferring 30% of the equity corpus to debt funds. So you'll set up monthly auto transfer STP of 1.1 lakhs from equity to short duration debt fund. And after 1 year, by June 2026, the equity balance grows to 40 lakhs, compounding at 11.5%, and debt funds have accumulated 14 lakhs. The total corpus comes to 54 lakhs. Do you notice what just happened? We didn't predict markets, yet the risk has already reduced. In June 2026, which is T minus 2 years, almost 20% of the goal money is in stable return debt funds. Now, suppose you decide to transfer another 50% of equity amount in June 2026, which is T minus 2 years. So, monthly systematic transfer would be around 1.7 lakh from equity to debt. As on June 2027, which is 1 year before the goal deadline, your total corpus is 62 lakhs, out of which 22 lakhs is in equity. Watch how safety starts accelerating. More than 60% of the goal is protected by now. Final June 2027, which is T minus 1 from the goal deadline. Some investors choose to gradually move the remaining equity exposure to debt over the final few months. So, by December 2027, which is 6 months before admission, almost all equity would have moved to debt. Debt balance will be almost 66 lakhs. And finally, on gold day, that is June 2028, total post tax corpus parked in debt funds would be around 70 lakhs. So you will safely meet your goal of 65 lakhs irrespective of the market volatility in that year. Now comes the question that everyone asks. What if markets rally in the years when you were transferring money out of equity to debt? And if those years are bull markets by any chance, risk management would feel wrong because you would think that the opportunity cost is huge. Here's the honest trade off. Scenario A, markets rally 30% over the next 2 years after you started STP. If you had stayed in equity, the gain would be of 10 lakhs. By transferring in debt, it would have given you a gain of around 2.3 lakhs. So, net opportunity cost would be around 8 lakhs. Scenario B, markets crash 30%. You're still 100% in equity. Your 65 lakhs corpus became 45 lakhs. You need the money now for your goal, but you're sitting on a loss of 20 lakhs. Now you can assess the asymmetric risk yourself. Risk 8 lakhs potential upside or risk 20 lakhs downside in your goal corpus, the money that you actually need. Which regret can you live with? I could have made 7 8 lakhs more. This could be a temporary sting versus I couldn't meet the financial goal for my child's education. But this would be a permanent damage. The takeaway is that markets are volatile and they can correct anytime. Nobody knows the peak and the bottoms. But goal dates and goal amounts are predictable. And we can protect our goal corpus without timing the market by using STP for systematic transfers. STP can help reduce the impact of bad market timing on your long-term goal corpus. Okay, till now we have discussed that you should transfer to debt from equity to safeguard your long-term goal corpus. But where in debt exactly? Okay, so for goals that are 2 to 3 years from your goal maturity, many investors evaluate short duration debt funds. These invest in corporate bonds and government securities, maturing between 1 to 3 years. Historical returns are around 6.5 to 7% per annum. They have low volatility and much higher returns than savings accounts, of course. For goals that are 1 year from your goal maturity, you can consider liquid funds. These park money in commercial papers, treasury bills maturing within 91 days. Returns are of around 6% per annum. These funds are quite liquid. You can also consider fixed deposits. Debt funds are taxed at your income slab rate. If you are in the 30% tax bracket, 7% becomes roughly 4.9% post tax. Critical caveat: which funds to choose, amounts to transfer, and when to start. All of these decisions need a SEBI registered financial advisor who understands your unique financial situation by assessing your risk tolerance, your goals, timeline, tax bracket, and all your other investments. So, to conclude, goals aren't just about hitting the target number. They are about actually having that money when you approach your goal. SIP helps to climb the mountain and STP helps to descend it safely. Because serious investors plan entries with SIP, but smart investors also plan exits. Do let me know if you have any questions about STP in the comments. If this changed how you think about exits for your long-term goals, do share it with someone who's approaching a major goal and with a fellow investor. And do subscribe to the channel to not miss data-backed and actionable investing frameworks for long-term investors like you and me. Also, do subscribe to the free weekly newsletter where I share weekly updates with you about market news and all that is happening and how it impacts your money. Thank you for watching. See you in the next one.